with the latest on the corporate front, all the market trends, expert opinion, and sound business advice. It is your unique window into the business world, direct from the heart of China.
Hello and welcome to Biz Today. I'm Zhao Yang in Beijing. Coming up, we will have half an hour of business news and analysis. On today's show, market rally, a recent bullish run sent the Chinese mainland Asia market capitalization to a record high, surpassing 100 trillion yuan. And the U.S. national debt surpassed 37 trillion US dollars, as President Trump is calling on the Federal Reserve Chairman to lower the interest rate. And now let's begin with our top story. China's stock market has hit a historic milestone this week. The Shanghai Composite Index climbed to its highest level in a decade. At the same time, the total market capitalization of A-shares broke through the 100 trillion yuan mark, or nearly 14 trillion US dollars for the first time. Since April, the benchmark index has increased more than 20%, with tech-heavy boards like Chanext surging nearly 50%. So what are the main factors driving this rally? Compared with previous bull runs, what feels different this time? And what does this mean for China's economy and financial markets? For more on this, join us on the line now are Li Lun, Assistant Professor of Economics, Peking University, Chen Jiahe, Chief Investment Officer at Novum Archi Technologies, and also Yan Liang, Professor of Economics, Willamette University. So I will start with you. China's A-share market has crossed the 100 trillion yuan mark this week. So how significant is this milestone for China's financial markets? And what does it tell us about the current state of China's economy?
Well, I think this is a significant landmark. Not only do we know that the stock market is rallying and the Shanghai Composite Index, for example, just taking in its gain this year to 11%, and that's a 10-year high. And I think it's also important to note that these stock market rally comes also with low volatility. So I think that's a sign of a more sustained rally compared to, let's say, October last year. And because the stock market in China is still relatively small compared to its GDP, it's around 71% of the GDP. But it's a very important, I think, bellwether curve for the economy. It's a barometer of a market expectation, right? The forward-looking view on the market, on the economy. So I think the fact that there is a stock market rally and the stock capitalization has surpassed the 100 trillion mark, I think that really indicates that the market is forward-looking, that there is a positive outlook on the Chinese economy. And with this low volatility, I think this market is going to sustain. And I think that would be helpful to produce some positive wealth effect, to stimulate consumption demand, and also help businesses to be able to raise funds to have more earning distributions, and also to provide more impetus for corporate investments.
And Jiahe, so what do you think has been driving this market rally since the beginning of this year?
Well, basically speaking, we see the market has been rallied because of the sentiment of the market has been rising. I mean, the market has really been going up a rising period since the beginning of this year, and this kind of motion really accumulates in the market. That when people see some people are making money, it started to jumping in. So this has been continued for like a few months. I mean, it started from large state-owned companies like banks, etc., and then transferred to some tech companies, and now it's coming to small cap companies. I mean, the recent movement has been concentrating with the small and medium, especially the small cap companies. And this is where most of the retail investors are actually putting their assets in. So that's why we see that with the rally of stock indices by not a very large extent, we see investors are really happy nowadays because they are really making a lot of money in recent trading weeks.
And Li Lun, so since April, the Chinex index jumped nearly 50%, outpacing the main boards. So what does this tell us about investors' appetite for the tech and innovation-driven industries?
Yeah, so I think this is a very healthy signal that tells us that the investors, instead of like the earlier bull markets, sometimes investors rush in for Baijiu or banks, or even sometimes kind of irrational stocks. Here we're seeing strong fundamentals because everyone can see that artificial intelligence, like robots or high tech sectors are definitely the future of civilization or human growth. So we're seeing not only China's index, but also the Hang Seng also have a tech index, which also surged 33% in just a month. So if you compare that with Nasdaq, it's basically a 50% growth since the beginning of this year compared to 11%. So similar to Chinex, I think the global investors are paying more and more attention to China's tech innovation, and these innovations are basically unique to China because a lot of the technologies and products are are unique varieties and new innovations only in China. So I think this provides a very good opportunity and growth prospects for these global investors, especially as the AI supply chain and also the humanoid robots begin to have its wider applications. So I think it provides a very healthy sign for the future growth of Chinese stocks.
And Jiahe, what do you think? To what extent have sectors like artificial intelligence, digital transformation, and high-tech innovation been driving the investors' confidence?
Yeah, we can see that investors are really chasing these stocks. I mean, the new tech, AI, these kinds of things. I mean, people are amazed by how much these companies can do and how much these technologies can potentially change their lives. And indeed, some of the technologies are already changing our lives. So these things are really taking up the headlines of the stock market. It's actually taking the headlines of everywhere, the daily lives, and people start to chase these companies. In the stock market, it's every time when you have some kind of stock movement, it's because that there's something that is really amazing. People don't get amazed because of a company's profit increases at maybe say 3 or 5% a year. They don't get amazed because of these. They look forward to companies that make 50% increase, or looking at some of the Hong Kong stocks recently, the consumption stocks whose profit increased by about 200% in just one single financial statement. And that's the companies as they start to chase. This is always where people are loving to put their money into. But that also brings a little problem that they should care for the valuation. I mean, if the valuation goes way too much, for example, above 50 times PE ratio, then that's also posing a threat to the investment result, even if you have got a very amazing company.
So how might this rally reshape the global investors' sentiment towards China, especially under the complicated international political and economic situations?
Right. So I think this recent rally is driven by multiple factors. And I think in addition to what Jiahe mentioned earlier, we also saw that the prospect of the US Fed cutting rates that also helped to really send many of the Asian markets upwards. But I think there are also very specific Chinese factors. So there's abundant liquidity within China, households and also other retail and also institutional investors. They're pivoting towards the stock market away from bonds or bank deposits. And so I think that kind of abundant liquidity helps to also drive the market. But there's also easing trade tension as China and the United States extended the trade truce for another 90 days. And there are also plenty of policy support to really support the Chinese equity markets. If you remember, there was monetary policies that helped to set up the relending facilities for stock buybacks. There are also broader fiscal expansion that we have seen the fiscal expenditure up by 3.4% for 7 months. There's also a lot of policies that help to boost the consumption demand and also help to regulate the supply side, for example, anti-involution competition, and so on and so forth. So I think all these factors, and not to mention, I think China's technological innovations, as DeepSeek just released the third version, and I think it really shows the competence, with China's development in AI and so on and so forth. So I think all of these factors help to boost the market sentiment, including attracting, foreign investors. At the same time, I think there are concerns about the U.S. stock markets. Again, the Fed is still hesitant to cut rates because of inflationary pressure. The job market has been cooling down. And recently, we also see the U.S. stock market had a sell-off of $1 trillion worth of stocks, largely because of some of the concern about these tech investment fervor. That according to the MIT, 95% of companies are not really gaining from the AI. Only 5% of companies are actually gaining from it. So I think all of this factor would, in a way, not only push investors look, outside of the U.S. market and towards Chinese market, but also pull the investors due to China's strong economic performance and also positive outlook.
And Li Lun, so with the A-share market surpassing 100 trillion yuan, so do you expect more foreign capitals inflows? And what are the key factors the international investors are watching right now?
So I think for the foreign investors, of course, earning is very important because China's currently have a advantage of lower PE ratio versus US. So I mean, in China, many of the tech stocks or high growing stocks have like 10 to 12 PE ratio versus in the US, it's easily more than 20 or some even more than 30. So this is a very compelling, advantage because it shows that, many of the Chinese stocks are underpriced. I think overall, we are seeing a more healthy, more rational stock market in China. So I think overall, we're heading towards a much more attractive A-share market for foreign investors.
And Jiahe, so what do you think are the key factors the international investors are watching right now?
Well, that's really a good question because you've got multiple types of international investors who come to invest in China. So basically speaking, they all look at one very important thing is the growth of the Chinese economy and the growing of China's position in the global market. That's a very key issue. I mean, no matter you're coming as a value investor or you are coming at a quantitative fund, you look forward to a stable market. You look forward to a market that is becoming larger and larger, and you look forward to a market that really welcomes foreign capital. So this is unique among different types of investors. And when we look at the various types of investors, beside this very major point, they can look at many different things. For example, long-term value investors look forward to the fact that China's economic growth is having a very large potential in the long term. So that is to say the current per capita GDP is still less than 15,000 USD per capita, which means this market has a huge potential. I mean, if you go to the local domestic consumption market, you can see many subsectors are growing out at a very amazing speed. For example, the retailing of food, the retailing of snack food supermarket has been a recent movement. You see this kind of companies growing at, I think it's about 50 to 100% every year. So this is amazing. And if you look at pet food, the local pet food companies are growing at 20 to 30% per year. So for long-term value investors, they look for these kind of things. And for short-term value investors who make arbitrages between the value of different companies, they also love this market because China's market is fulfilling with enough liquidity. The market is not that matured, which means you have a lot of mispricing between different stocks. And for these investors who make a lot of trades between different value priced companies, this is also a very good market. And if you talk about quantitative investors who use computer programs to grab opportunities, China's market is also very attractive to them because this is an unmatured market, and this is a market that has a huge amount of liquidity that allows the quant funds to work effectively. So I mean, different investors look for different things in this market, but altogether they look to this market because China is growing and China is important in the world.
Well, we're speaking with Chen Jiahe, Chief Investment Officer at Novem Archi Technologies, Li Lun, Assistant Professor of Economics, Peking University, and also Yan Liang, Professor of Economics, Willamette University. After a short break, U.S. national debt surpassed 37 trillion US dollars. Stay with us. You're listening to Biz Today. I'm Zhao Yang in Beijing. The U.S. Treasury Department says the U.S. government total national debt has exceeded $37 trillion for the first time. This comes several years earlier than predicted. From the start of this year, Trump has urged Federal Reserve Chairman Jerome Powell to cut the interest rates. Trump has repeatedly stated that the U.S. government is paying huge interest on its debt. Maya McGuinness, president of the Committee for a Responsible Federal Budget, says the U.S. fiscal situation is severely unbalanced. So yeah, actually the U.S. government debt has surpassed $37 trillion. How significant is this milestone for the economy and the financial markets?
Well, I think this is significant. I think the earlier estimate said that this mark will be surpassed only in 2030. But now, as you just mentioned, we're much earlier to reach this sort of the mark. And I think it is very significant in the sense that, in the high interest rate environment, this basically leads to very high, interest payments. When you look at the projection, the federal outlays in fiscal year of 2025, the net interest payment will reach $841 billion. In fact, I think the CBO projected even a higher number at the $952 billion. So this is the second largest outlay after the Social Security and before the Medicare, national defense, and so on and so forth. So what it means is this will have tremendous distributional impact because this net interest payment are to the bondholders who are pretty much rich groups in the U.S. economy. Not to mention, I think there are concerns about how the bond vigilante, right, the bond investors may demand higher interest rates. And again, if the Fed does lower the interest rate, that will help to offset that. Or if the Fed directly purchase the government bonds, that would also help to offset that. But right now, I don't think that we're seeing this happening. And again, the Fed may lower the interest rate in the next meeting. But again, there are a lot of concerns about inflationary pressure that is building up in the U.S. economy because of the various, tariff policies and also restrictive, immigration policies. So I think all of this would simply mean that, in a high interest rate environment, when you have very high government debt, this means that, a lot of the budgets will be compromised. So instead of spending money on the economy, on public investments or, social welfare or other more necessary spending, this money will go into the bond interest payments. Again, mostly is a negative wealth transfer to the richest households or individuals in the economy. And again, I think there are also the concerns about with the U.S.'s economy now struggling with the tariff implications and also other broader economic headwinds. I think the idea is that without a more meaningful spending on the fiscal side, on the fiscal front, this is not going to be helpful for the economy going forward.
And Li Lun, so what are the real-world consequences of this debt for American, households in terms of mortgage and car loans and wages?
Yeah, so I think realistically, I think because of these huge federal debt, so the federal government in the short term is basically unable to provide any meaningful stimulus for consumption, for example, because, as Professor Liang mentioned, the interest rate payment is surpassed national defense and Medicare. So it's difficult to see that, the federal government increase, for example, the stimulus or give a paycheck to everyone for their, new car purchases and so on. I think also part of the effect is that we are seeing a really high mortgage rate and interest rate. In some cases, for example, if you look at auto loans, so the rates for a 60-month loan for a new car is around 8% as of today. So it is a very high level, a historical high level, and you can think about the pressure it brings to U.S. consumers in terms of buying a new car. And also the mortgage rate is very high as well. So depending on the state and your credit score, it could range between 5 to 7% or even higher. So this puts a very a very large burden to U.S. consumers. And in terms of wage and inflation, so we're also seeing a very high inflation expectation. So if the wage growth doesn't follow the inflation expectation or the inflation growth, the consumers will feel more and more price pressure through their grocery trips. And also the inflation is expected to grow even further with the tariff pressure and the new tariff policies. So I think so overall, it is definitely good for the debt level to stay lower because the fiscal policies and the federal government can have a better chance to helping these households. Right now, I think their hands are tied. They don't have much policy space to help them through fiscal policy.
And yeah, we've also seen the PPI in July jumped 0.9% month on month. This is the biggest spike since the year 2022. So are we seeing the signs that the tariffs are starting to feed through to broader inflation?
Well, I think that is definitely one piece of evidence because the PPI measures the factory gate price. So when the PPI rises, then typically with a lag, it's likely to see the CPI also rises because producers are going to pass on the higher cost into the prices. And so consumers are likely to see the price to go up. And I think, again, the inflationary pressure is building up in the US economy, even though there are many people who argue we're not really seeing a very large price jump so far. Despite the tariff war, and therefore this whole inflationary sort of scaremongering is overblown. But let's not forget, in the previous months, pretty much the Liberation Day tariff was on the truce. So it's not until August 7th that the new tariffs kicked in. And I think the early research, according, for example, to Goldman Sachs' research, that shows 64% of the tariffs were so far borne by businesses, but that would soon fall to less than 10%. Because businesses are not going to sustain the kind of rising cost and thinning profits for long. They are going to pass the cost on to consumers. Right now, about only 22% of the costs are borne by the U.S. consumers, but that will go up to 67% by the end of this year. And so they projected that the core PCE, the personal consumption expenditure, is going to hit 3.2% by December. Up from 2.8% in June. So this PCE is the favorite, inflation gauge by the Fed. So the 3.2% is definitely higher than what the Fed would like to see, which is, 2% of their target. So I think the long story short is that, we are seeing inflation pressure being built up. Again, the contention now here is whether or not inflation is going to be worse than the labor market cool down. So I think the Fed's opinions are pretty divided. The San Francisco Fed Chair said, this inflation and jobs market cool down combination would warrant twice cuts this year. But Chicago Fed said, they would like to see more disinflationary signals for the Fed to really go ahead and cut more rates. So I think, because of tariff war and other policies like restrictive immigration policies that reduce the supply side expansion, I think all of this will push the price higher, giving the current sort of the reading of the early signs of the market.
Now, President Trump and Treasury Secretary Bessent called the Federal Reserve on cutting the interest rates. So is that realistic given the current inflation trends? And what would be the economic risk of cutting rates aggressively? Yeah.
Well, I think the Wall Street is now pretty much pricing in. They expect a 50 to even 75% cuts by the Fed for the remaining of the year. And so, the next Fed meeting is around the corner in September. And so we're likely to see some rate cuts, but the question is how much? And what is interesting is, the actual rate cuts themselves may not have much of a benefit if they're really anticipated and also priced in. So it may help to cushion somewhat the economy, but it's not going to, really make a huge positive stimulus. And I think the downside risk is also pretty large. We know that, the job added in July was much lower than the economists' expectation. It was only 73,000 jobs that are added in July. Usually, economists expected over 100,000. Not to mention, May and June's job added number was also revised down by 258,000. So what it says is that the economy is seeing some weak sign, especially in in the labor market. And also, manufacturing sector in July, basically the factory activity did not expand. It pretty much leveled off. So I think all of these seem to suggest that a rate cut is necessary. But again, because of the inflationary pressure, I think the Fed would have to think twice if they're willing to make that cut. And of course, there is a political pressure coming from Donald Trump as early as January 23rd. When he took in office, just 3 days later, he already urged the Fed to lower the interest rate and multiple times, urged the Fed chair to cut rates. But again, Fed has their own considerations. They are very much based on, the data. So I think it remains to be seen, even though there might be rate cuts, the rate cuts may not be as beneficial as people would like. And also in terms of the pace and the scale of the rate cuts, I think that is still a question, depending on, what the really the inflationary pressure looks like, given now the tariffs are in effect as of August the 7th.
And yeah, if you could advise policymakers on one urgent priority, for example, controlling inflation, cutting debt, or boosting growth, which should come first?
Well, I think that's a great question. I think the fact is that there are many policy missteps by the Trump administration. I think this tariff war is complete self-inflicting wound, and so that could definitely go. And when it comes to, cut rates, I think, again, that would depend on whether or not the economy is showing some signs of controlled inflation and also, job market performance. When it comes to debt, I think this is a difficult question. I think on the one hand, some fiscal expansion is definitely helpful for the economy. At the same time, with the interest payments, as Li Lun also talked about, this is not very meaningful when it comes to stimulus to the economy. So I think, all of this just mean that a lot of the problems in the United States is structural. It's not one or two policies could fix. But there are many policies that definitely need to be revamped, the tariff policies, the immigration policies, and also the scale back of industrial policies. I think all of these need to be revamped for the economy's good.
Well, we're speaking with Yan Liang, Professor of Economics, Willamette University, Chen Jiahe, Chief Investment Officer at Novum Archi Technologies, and also Li Lun, Assistant Professor of Economics at Peking University. And that's all the time for this edition of Biz Today. To listen to this episode again or to find more previous episodes, you can download our podcast by searching for Biz Today. I'm Zhao Yang in Beijing. Thank you so much for listening.